Hey guys, what's up? This is Brian, and today I wanted to make a video for you guys talking about R multiples and compounding and what to kind of expect and kind of how to build it because I get this question quite a bit in the DMs, and I hope that by illustrating the point through Excel, I can kind of point you in the right direction and help you figure out what to look for. So, first of all, what I have here is kind of a smaller version of what I'm doing personally. It's much more stripped down, and the UI is adapted towards helping you guys understand visually what's going on. But first of all, I wanted to just point out some of the different elements of what you're looking at here. So, first of all, you have your starting capital here. So, I'm just going to go ahead and pretend, 27,000, you're above PDT. This is kind of where I started as well. And on the left hand side, you see the R. So R, for those of you who don't know, represents risk per trade. And when it comes to risk per trade, it's usually, for me, it's a percentage of the account. So in a lot of cases, 2% is something that people will do as a very aggressive means of growing their accounts. 3% is extremely aggressive, and then 1% would be pretty mild. Below that, you can do maybe 0.5%, whatever you want. You can adjust it to your own style, and then I'll go ahead and explain why that matters a little bit later on. And then we have here the 3R. So we're going to be using these 3R, minus 4R, minus 2R as guides for filling out our little mock calendar here, because these are very real situations provided that you're looking for the right risk reward ratio. For me, 3-to-1 is exactly the bare minimum that I'm actually going to take the trade with. So I expect to be making 3R on any given day on a successful trade, sometimes a bit less. But we're going to use this as a guide. And then just to clarify with the fees plus slip, I'm using like minus 4.5 times to account kind of for a little bit of slippage and locate fees on top. This only applies to short sellers, but when you're short, you're not only losing, but you're also paying those locate fees. So you have to keep that in mind. And these are just my general metrics, roughly. Yeah, my mouse is kind of blinking a lot. Just bear with that. Hopefully it's not too big of a distraction since the last Windows update. It's been a big problem for me. But let's just keep on going. So up here at the top, we have a starting capital. So I just entered that in manually, and then we have here account size. So what I've done is I linked my account size to starting capital plus whatever total we're going to get here at the end of our calendar. So it's just adding onto this. That will help track our overall account size. So that's very important for compounding. And then I'm going to go ahead and skip over here real quick. So now we have risk per trade at 1%. 1% generally would be this account size number times 1%. But what I've chosen to do is say, you know what? If I risk 1% of 27,000, I'm risking about 270 per trade. 270 per trade. I'm $2,000 above PDT, so we're gonna go ahead and say that that's about 7.4 losses, and those are perfect cuts, without slippage, without fees. So that's a big deal. I don't think I can personally withstand that kind of pressure, and I would rather give myself a little bit more opportunity to fail. So for me, as a somewhat experienced trader going on 2 years, I say that 15 losses is enough for me. So I'm going to go ahead and reduce my account size by half. So I'm taking my account size, reducing it by half, compounding. So this is now my simulated account value, 13,500. And I'm taking 1% of 13,500, give me $135 per trade. So if I risk properly and follow my rules, when I do cut the trade, I should be losing $135 plus commissions, NEC, and fees. But the R multiple is really what matters. You're going to be above or below, give or take, a couple dollars based on, if you're hitting it, if you're taking liquidity or whatever it is. And then here I have it routed to above PDT. It's self-explanatory. How much, how much are we above 25,000? And then I have a calculation of how many dollars are above PDT and my risk. And it will tell me, I can lose 15 times in a row, more or less, and that will give me back down to PDT. And then you can set this number to whatever your risk of ruin is, which is another concept that you might want to be familiar with. It's something you can definitely Google, but essentially you have a predefined, value of your account that you would consider a disaster or something that you would definitely want to avoid. And for me, PDT is definitely something I want to avoid because there's a lot of mental stress that goes along with it. Even though $25,000 is quite a bit of money, as you get lower and lower down towards PDT, you're going to start making some incorrect decisions, such as not selling or following your risk because you're afraid of falling underneath that number and not being able to day trade freely. So this is a really good metric for you if you're in this area, as I was. And then here are my daily max loss and my position loss. My daily max loss was set to 4R, so that's 4 losses in a row. That will lock out my platform. And then my position loss would be minus 2R, so on any given symbol, if I take 2 full losses, then I'll be locked out. And one thing that I want to talk about in regards to max losses is that, at least with my broker, they don't close out your position, so they're not going to market order you out. However, you're going to be unable to flip your trade. Let's say you're short and you double your position buy long to flip your trade. You're not going to be able to do that once you hit that threshold. You're not going to be able to add to losers, averaging down. And that's a really big deal because that kind of protects you from yourself. And really, it gives you one option, which is to get out wherever it's up to you to close the position. Just keep that in mind. So that's why I account for slippage. And slippage can also be a result of hard stops being triggered at the market, which can also be a big deal. All right, so now that we're getting into it, let's go ahead and just kind of like fill out maybe an average spread. So let's just say Monday, first day in new system, we're having a great time. We're gonna go perfect 3R, $405, okay? Now, one really nice thing about compounding is that you see here this number, 18 losses to PDT. When you experience losses, it's actually going to reduce the amount of risk you take per trade. So it's actually going to be a lot more than that. This helps curb the risk of ruin calculation, which is a really neat aspect of compounding. And I'll give you an example here. So I'll say that, okay, the next day we screwed up real bad. We lost $1,000, right? So now we're going to be reduced to $132. So instead of that initial 135, we're risking 132. As the lower and lower we go, let's say we risk we lose $400. Again, it's 130. So it helps curb it a little bit, and the more aggressive you are, like if you're taking 2% or if you're using your full account size, that number will reduce dramatically. But hopefully you're not in this situation. But this does happen, so let's just go ahead and work with this. So now we're kind of in the hole. We're back at 130, which is $5 underneath our initial risk. Say we have a pretty good day. We're gonna make 390. Maybe we win another day, 396. Okay, so I'm using this right here. Now let's say we go ahead and make another 3R, which is great. So we're green, and then we take $340 loss the next day. And I'm just gonna go ahead and fill this out. You kind of get the point. I'm just gonna make sure that we understand what this compounding might look like. And just, if you want to keep track, you can kind of look on the side there and just see how our risk kind of evolves, what kind of losses we're taking relative to the next. I mean, this is a pretty aggressive win rate. I don't think that people, like, sometimes you'll experience something like this, like you'll just lose way out of your zone, and that happens. And sometimes, I mean, one thing that I didn't really do is sometimes you overperform. Like some days you'll make like quadruple, and that definitely happens to me as well. And let's just go ahead and win again, and we'll say we closed out really strong. We doubled it up somehow. All right, so this is a pretty aggressive example where you're winning a lot, but I just want to illustrate like how R can kind of scale with the trades. And I think I should have mapped this out correctly. So you can see here that when you're compounding the account, your dips and your peaks and valleys are kind of progressively going to be in your favor, because in terms of risk reward, your expectancy is very positive when you win 3 times as much as you lose. And most days that I stop trading are a result of getting stopped out for the max. Like, I might get stopped out of 2 times on a position, I'm done. Or I'll get stopped out for, a large amount because I didn't follow my rules. Or I just get stopped out from my daily max loss. But generally, I'm ending pretty green. And we can compare, from 1 month of trading, we've grown our accounts from 27,000 to 30,000. And we are now risking 150 per trade on a 1% of our compound. And if you can remember, our compound was only 1/2 of 27,000, so we started at 13,500 ish. And so this is a way that you can safely grow your account and also use the power of compounding in your favor, because when you can see that when we started winning at the beginning of the month, we were making $405 per 3R. And then towards the end of the month now, we're making $455. And you can be a lot more aggressive about this. You can use 2%, whatever it is, but that's really what it's all about. And for me, because I'm not being really super selective with my trades and trying to go for home runs, like sizing in with conviction on something that I really, really believe I have an edge in, but rather I'm taking each trade with a set amount of risk that's pretty low, in my opinion. I have a lot less stress, and I'm letting the positive risk reward expectancy guide the way. This also allows me to take, positions that are considered like less liquid for bigger traders. But I combine this with my ability to take larger moves, make multiples, and that really grows the account, because you can see we're only making a couple $100 each day, but by the end of it, we've netted 3,000 on our simulation. And this is on a really, really basic 3R formula. In a lot of cases, for me, I'm making 4, 5, 6R per trade, and that heavily outperforms the drawdown. So when I have big days, when I have big weeks, those profits do add up huge. And then you do this over a couple different months, and that will grow your account very, very quickly. This is a really beautiful way to grow your account, and I hope that kind of gave you a bit more of a visual perspective of what I've been talking about on Twitter. And I hope that you can build something like this for yourself and avoid risk of ruin, because in my opinion, once you do learn how to trade, once you have an edge, It's a lot about your self-mastery. It's a lot about reducing the drawdowns, minimizing your risk, and really honing in this risk of ruin, because it only takes one day to really do serious damage to your account. You're only one step away from averaging down or using margin on your account, leverage, and taking too big of a position where you'll freeze and not be able to handle it. And I really caution people against that, and I'll never risk my account again. And so, yeah, I hope you guys enjoyed this video. And yeah, let me know what you think. And if you have any more questions, just message me on Twitter. And hopefully I'll be able to make more videos in the future. So yeah, thanks guys. And follow me on Twitter if you haven't already at Brian Lee Trades. I'll link it in the comments section below. Thank you.